professionals in our community. First, Ashley Brooks, who is a mortgage broker, and then Taylor Askin, who is a realtor. And so we're in for a real treat, because first, these two individuals are just really interesting people, not in addition just being experienced, but just really interesting. So a little bit about Ashley is that first she grew up in Paradise, California, which is the most resilient community in the North State. So after the fire, they moved to Durham alongside her husband, Chris, who is a firefighter with the city of Reading. And so they put their roots down there. And as the ridge is rebuilding. And so Ashley does a lot of volunteer work in the areas of rebuilding our town of Paradise. With her experience, her personal knowledge, her love for the community, especially for the North State. And so one of the things that she doesn't brag about, but I think should be thrown out there, a little humble brag towards her, is that she is one of the top producing loan officers in the North State. And she is also a fellow Best of Chico professional as well. And so I know, because we have a lot of mutual clients, that she really goes above and beyond in her interactions with our clients. And then with Taylor, so another really just exceptional professional in our industry as well. So Taylor's really interesting. He grew up in Manteca, California. And so then he, after high school, this spirited young man took off for Europe and traveled and spent some time in Germany, right? Yep. And so then met a beautiful woman, and they set up life in Chico. And so they have 2 kids, and 2 or under 2. Right? Is that right? And then you also have one that is following your path in the real estate industry. And what he does that is so interesting as well is that he has a YouTube channel where he highlights a lot of the homes, HGTV style. And so with that, what I'm going to do is I'm going to turn it over to Taylor and Ashley to tell us about what's important to know about the home buying process.
Awesome. Thank you so much, Kim, for the introduction. I really appreciate it.
Yes, likewise. All right, so I'm going to share my screen and we're going to jump right in. Okay, can everybody see that?
Yes.
Okay.
Might have to make it full screen.
I think that's what I've got for right now. Okay, so this is a high-level overview of what you'll see in a real estate transaction. First, you'll start by calling me, and then from there, we'll get you over to Ashley to get pre-approved. Then you'll meet again with me to have a consultation, and we'll start looking for homes. Once your offer is accepted, there's 3 main things that we'll look at: inspections, appraisal, and then your loan approval. Once all of those are in place, then you get keys to your home. So
now we're going to start into some real estate terms. So we're going to go over some basic terms with you guys, because these are going to be some popular terms that you're going to hear throughout purchasing a home. One of the first terms that we like to go over is a pre-approval and what a pre-approval is. So a pre-approval is one of the first steps that you're going to be taking when you look at purchasing a home. For a pre-approval, what we're going to end up doing is doing a consultation, going over what your goals and aspirations are, and making sure that we're staying within a budget that helps meet what you're looking for. We're going to go through all of your income documentation, go through your credit report, make sure we're on the same page with what your goal is as far as a purchase price, and then issue a pre-approval letter so that you will be able to put an offer in on a property when you find the right one.
that's right. And your good faith deposit is between 1 and 3% of the purchase price. And those funds are cashed and held at the title company. And that lets the seller know that you're serious with moving forward with the purchase. And the offer is just an agreement between you and the seller to purchase the property.
Wonderful. Now, one of my favorite things to explain is contingencies and what that means. So earlier, Taylor had just touched on a good faith deposit. Now, what contingencies are the items that are going to protect that deposit. So when we're looking at your deposit, think of it similar to a security deposit for an apartment that you may be renting. And when you put that deposit down, there's going to be 3 things that protect that deposit, and those 3 things are called your contingencies. Now, your first contingency is going to be your inspection contingency. Your second one is going to be an appraisal contingency. And your last line of defense is going to be your loan contingency. Now, what that means is in the offer that you would put together, let's say that you find a property and it's worth $450,000, and that's what you put your offer in at. And then we say, hey, I'm going to put a $5,000 earnest money deposit to show the seller that I'm good to move forward with this transaction. Well, then what we want to do is look at your contingency inspection period. So what these contingencies are saying is, hey, Mr. Seller, I'll pay you $450,000 and here is my deposit to show I'm good for it, but I need to make sure it passes inspections, because if I find out your roof is caving in, I might not want to pay you $450,000 and I reserve my right to negotiate. Now, the next one is going to be the appraisal, which is saying, hey, I'm going to pay you $450,000 for this property, but I'm going to get an appraisal to make sure it's worth $450,000, because if it's worth $400,000, I might not want to pay you $450,000, and I reserve my right to negotiate. And last but not least, I'm your last line of defense, which is saying, hey, I'll pay you $450,000, but I need to make sure that my loan's going to go through, because I might not have $450,000 that I want to pay you cash for this property. And at that point, I still reserve my right to negotiate. Now, there's going to be certain time periods on each one of these contingencies. And typically what we're seeing is that by 17 days, all of your contingencies should be removed. Now, in that process, we're going to make sure that we have your deposit good, because Taylor and I are here to make sure that your financial future is going to be set up for success. And we're going to make sure every aspect of this is dialed in before your contingency is released. Once your contingencies are released, in order for the seller to get access to your deposit, all 3 have to be released. If all 3 are released and you decide, hey, I might not want to move forward with this property, well, then at that point, the seller would have access to your deposit, but Taylor and I are going to make sure that we never get to that point and you're comfortable moving forward to keep that deposit protected.
Right.
Now, the next term that we're going to hear is appraisal. And we touched a little bit on appraisal just a moment ago, and an appraisal is going to be a third-party individual that is going to go out to the property and make sure that there's comparable sales to value the property. And that appraisal report is going to come back to you, and it's going to give you what the value of the property is estimated to be at, to make sure that you're not spending too much on a property if it's not valued at that amount.
That's right. And the title search is to confirm that the property belongs to the seller. They'll make sure that it's free and clear of any liens or judgments, and that all the taxes are prorated at the close of escrow. Disclosures are everything that the seller knows about the property. And in escrow, we'll get all of the disclosures and we'll be sure to review them with you.
Then we have closing costs. And closing costs is just a fun way for a lender to save fees. And there can be a lot of fees when you're looking at purchasing your home. So it's important to know what those fees are and how you might be able to get around paying those out of pocket. So for your closing costs, regardless of the lender that you go to, we try and prepare our clients for between 2.5% to 3% of your purchase price is what you should be looking at roughly for your closing cost fees, which are mainly comprised of prepaid taxes, prepaid insurance, and third-party title and escrow fees, not to mention the appraisal report fee. Now, the next one is going to be a supplemental property tax bill, and this one lenders always forget to touch on, but happens to be one of the most important things, especially if you're a first-time home buyer, that you want to make sure that you're prepared for. Now, in your monthly payment, we're going to have your principal, your interest, your taxes, and your insurance. Now, even though your property taxes are included in your monthly payment, if you're purchasing a home in California, you may be subject to, or you will have a subject of what's called a supplemental property tax bill. Now, this is going to be the difference of what the property was being taxed at versus what it's being taxed at once you take ownership of the property, because it will get reassessed. The more recent the property has sold, the lower your supplemental property tax bill should be. If the property hasn't sold in a while, or if the property might be a new built home, you may see a larger supplemental property tax bill that tends to come about 7 months after you purchase. Now, what's important about the supplemental property tax bill is that it looks exactly the same as your normal property tax bill, except for one little variance that's very difficult to spot. So when you're getting your tax bills, you always want to keep copies for your records. But for the first year that you own a home, I'm always going to have you send a copy of your tax bills to me so I can make sure that you're aware that this one will be paid automatically, or this one may be that supplemental property tax bill that we have to take care of out of pocket.
That's right. Preparing to buy. This is when you call me and say you're ready to buy, and then we get to know each other a lot better. And from there, we'll send you over to Ashley and she'll talk about 4 loan options that you have.
Now we're going to get into the fun part, your purchasing power. So one of the most important things is understanding how much you're able to purchase. Now, there's 4 different types of basic loans that all loan officers can offer. There's conventional, FHA, USDA, and VA. Now, all loans may not be best suited for you, but it's important to me to make sure that you're aware of the pros and the cons of each loan and where that would put your payment, so that way you have a good idea of what your options are. The last thing that we would want to do is pigeonhole you into one loan and say that I know best for you without letting you know everything that you might qualify for. Now, when we're looking at a conventional loan, the minimum credit score is a 620. If you're a first-time home buyer, the minimum down payment is 3%. And if you're not a first-time home buyer, the minimum down payment is 5%. This is also the most common loan that you hear about. When people say put 20% down so you don't have mortgage insurance, they're referring to that conventional loan. Now, on conventional, if you put 20% down, mortgage insurance will not be applicable. But if you elect to have a lower down payment, mortgage insurance will be applicable and is based off your credit score. However, your mortgage insurance does eventually fall off. And that will be something that we review together to make sure that you have a really good idea of where your payment's going to be, not just now, but also in the future. Your next type of loan is an FHA loan. A lot of people think of this as a first-time homebuyer's loan, but you actually don't have to be a first-time homebuyer to get an FHA loan. For this loan, the minimum credit score is 500 if you have 10% down. And if you have a 580 or higher credit score, then the minimum down payment is going to be 3.5%. Now, the con of this loan is that regardless of the amount that you put down, you're going to have mortgage insurance on this loan for the life of the loan. It also does not have a difference in mortgage insurance costs based off credit score as you would see on a conventional loan. Now, because there's mortgage insurance associated with this loan for the life of the loan, there tends to be a lower layer of risk for the bank, which can give you lower interest rates. But when we're looking at it, we want to make sure that we're factoring that mortgage insurance fee into the equation to make sure that we're saving you the most money that we can. Our next loan is going to be a USDA loan. USDA is for rural neighborhoods. Now, with this, we can't have Chico qualify or Orville, but Paradise, Magalia, and some of the other outskirt areas will qualify for a USDA loan. On USDA, the minimum credit score is 640, and there is no down payment requirement. On this loan, your mortgage insurance is going to be subsidized, which means that when you pay the loan off or refinance the loan in the future, you may be subject to pay small penalties back to USDA for lowering your mortgage insurance while you are going through the USDA loan. Now, with USDA, there are income limits, and they can be a little bit more strict depending on the property. They don't tend to like things that can be income producing. I've seen USDA not like chicken coops because you may have chickens and sell those eggs, and that would be income they didn't qualify you with. So we want to make sure if we're looking at a USDA loan that we're pairing it up with the property that you would like most to make sure it's reaching your goals. And last but not least, we have a VA loan. VA loans are for veterans. There is no minimum credit score requirement, but most lenders would like to see you above a 580. With a VA loan, there's also no mortgage insurance, and this happens to be one of my favorite loans, but you do have to be a veteran to qualify. Now, when we look at these 4 loans, what's important to know is that there's something called a first-time homebuyers program. And a lot of times people think that that's a whole separate program, but it's actually more of a cake topper for any one of the 4 loans I just mentioned. So when we're going over your options and your purchasing power, we're going to make sure that we go over all of the loan options for you, as well as explore those first-time homebuyers programs. But it's important to know when you're using a first-time homebuyers program, what your base product is.
That's right. And so after Ashley sits down with you and considers all of those options and you finally get pre-approved, that's when you'll come back, you'll sit with me, we'll have a consultation, and we'll talk about your fears and your haves and wants in a property. From there, we'll create a criteria where my team will start sending you homes that meet that criteria as they come on the market. Now, touring homes. So this is the exciting part. This is where you get to find your dream home and when you're going to plant or where you're going to plant roots. And this is the time that I am the most quietest. When we go into homes, I don't talk. The majority of the time when my clients go into the home, they know whether the home is right for them or if they can see themselves in this space. Okay. And once we find your dream home, that's when we'll make an official offer and negotiate, but be prepared, depending on what market you're in, that you'll get multiple offers or you'll get a counter offer or potentially have your offer rejected. But don't worry, Ashley and I will give you the best possible chance. I know that Ashley will call the listing agent or the seller's agent and tell them how solid you are as a buyer with in terms of your loan. And I do something that most agents don't do, and that is present your offer to the seller. And I've had a lot of success doing this. Once your offer finally gets accepted, then we go into the inspections. This over here is a list of inspections that I recommend that you get on a property. And say you get all of those inspections. Once they come back, we'll review all of them. And if there's anything that needs to be addressed, then we'll write that up on what's called a request for repairs. Now we go after, typically we go after health and safety issues with the home, but it just depends on what comes up. Now from there, the offer or the request to the sellers can be accepted. They can counter it and say, hey, these are our terms, or they can reject it. Okay. And if they do reject it, at that point, you get to determine if you're okay with how all of the inspections are and moving forward with the purchase.
Now, once your offer is accepted, on the back side, my goal is to take as much stress off of you as I possibly can. So when your offer is accepted, I'm going to be ordering the appraisal for you, and I will let you know when the appraisal will be turned around. And typically we're going to see about 2 weeks. And once your appraisal report comes in, I'm going to send you a copy, but it is about 85 pages long. So with that being said, I actually call you and go over your appraisal with you. So that way you understand where the property value came in at and make sure that you feel comfortable with where that value is. Now, while that's also happening, my team of professionals is going to be working with the underwriter to get your loan and approval status. So earlier you heard the term pre-approval. So a pre-approval is when we're looking at your items and we say, hey, we know exactly what the underwriter is going to be looking for, and based off what you've provided, you are good to make an offer on a property. Once your offer is accepted, that's when we start going into underwriting, and I'm here to protect you, and the underwriter is there to protect the bank. They're going to put somebody in the middle of us, and that's called a processor. Now, your processor will be Christy Hemry, and by the end of it, you will probably be closer with her than you are with me. You are going to love her. Now, Christy is going to be working with me and the underwriter as our liaison to make sure that we're getting your loan across the finish line in the smoothest possible fashion. So when we get submitted into underwriting, we're going to come out with what's referred to as our conditional loan approval. Now, what that means is we are approved to purchase this home, but the underwriter may have a few questions. Now, those questions aren't anything to be concerned about. We typically see those questions being, I need to have the appraisal report back. who would they like to use for insurance? And what is this address that's on their credit report from 4 years ago? We write a quick letter explaining those items, so that way we can move forward and get you what's called your clear to close approval, which means the underwriter has no more questions and we're getting ready to wrap your transaction up.
Now, your final steps. Once your loan's taken care of, once the appraisal and all of the inspections are done, then we move forward to closing and closer to getting your keys. Now, within 5 days before we close escrow, we'll do a final walkthrough of the property to make sure that the home is in the same condition as when you wrote it. That, and we'll also sign a few last-minute documents that are required.
And now it's closing time. This is one of my favorite times. This is when your loan documents are going to go over to the title and escrow company. And for my first-time homebuyers who are on this call, one of the things that I noticed when I was a first-time homebuyer before I was in the industry is the closing process was a little bit different than I had anticipated. For those of my first-time homebuyers that I have on here, if you've ever purchased a new car, you may remember signing your life away on 5,000 pages of legal documentation for that brand new car, and they handed your keys over right then and there. That's what I thought purchasing a home was going to be like too. Once my loan documents were out and I signed my name, I thought I was going to get my keys right then. But that's actually not how it works, and that's really important to know. So when you sign your loan documents, you're going to sign it with a title and escrow company. Now, the title and escrow company, we're going to think of them like Switzerland. They're going to be a neutral third party that goes over your loan documents after I've also gone over them with you to make sure that you feel comfortable with what you're signing. Once you've signed those documents, that notary is then going to send it back to us as the lender, and then typically it's the following business day, we'll be funding your loan. Once your loan has funded, we have to get on record with the county. And when you get on record with the county, that's when you officially own the home. Now, that typically happens 2 o'clock on that same day that we funded your loan. So I would always tell my clients after you've signed to prepare to get your keys after 2 o'clock the following business day. Now, once we've closed, one of the major things we want to make sure that you're aware of and make sure that you're comfortable doing is rekeying the property. This is now your home and you get to make it your own. And in that process, safety is always a top concern. So we're going to suggest that you rekey that property. And if you have any questions on that, please feel free to let us know. Now, after that, we're going to be looking at scheduling your move. Now, when it comes to your first mortgage payment, let's say that you got pre-approved today and you found a home in April. A typical escrow period is about 30 days. So if we're in April, your loan's not probably going to close until about May. If we close in May, your first payment isn't until July 1st. So we have a large window in which we close your property and your first payment is going to come due. So because of that, we try to suggest that you hold on putting in your 30 days notice in case anything comes up during the process that may change your move out day. Now, when you're scheduling your move, we always want to make sure that we don't get the moving truck until you have your keys in hand. It's okay to start packing up before then, but occasionally there can be some last minute things where maybe you're still negotiating with the seller. And at that point, we want to make sure we haven't spent any money up front on that moving truck that might have some out-of-pocket expenses that we weren't prepared for.
That's right. And if you need any cleaners or contractors, feel free to reach out to us and we can get you in contact. And with that, what questions do you have for us? And I'll stop sharing my screen and we can kind of get back. All right, so what questions do you have? Kim, you're muted. There you go.
Okay, wonderful. And so that was so interesting, guys. The let me see. So we covered a lot, and if there is any questions or topics that that we haven't covered that you would like to have discussed, go ahead and start throwing it in the chat. And while we're waiting for some of the questions to come in, I've already started a list of questions that I've been getting all throughout the year. So I'll start with Ashley. This one I hear a lot, but how can I avoid PMI without putting 20% down on a home? Is that even possible?
It is. So there's a few different programs that are considered non-qualified mortgages that will allow you to purchase a property without any mortgage insurance associated with it. Now, the interest rates aren't as fabulous. So instead, what we like to resort to is looking at what's going on with the mortgage insurance companies. Now, what a lot of people don't realize is that you don't have to pay your mortgage insurance monthly. So what I will do as your lender is I will go to the mortgage insurance companies, and we have 7 that every lender is allowed to use, and I make them compete to give me the lowest mortgage insurance quote on your behalf. Once I get that quote, I can ask them, if I didn't want to take it monthly, what would it look like if I just wanted to completely buy out my mortgage insurance? And they'll typically give me a number between 0.75% of your loan amount up to about 2% of your loan amount. Now, that amount we can add as a closing cost so that mortgage insurance is no longer applicable on your loan. And one of the other things that might happen is if we negotiate with a seller and you get what's referred to as a seller's credit, we might be able to actually have the seller pay to get rid of mortgage insurance on your loan.
That is so interesting. I didn't even realize that the PMI was even negotiable.
It is, yeah.
Pro tip. Okay. And then Taylor, here's another question that I'm starting to hear some buzz around, is that there's some news around a lawsuit going on in the real estate industry. What's happening there?
Yeah. So basically back east, a seller did not realize that they did not have to pay for a buyer's agent's fee. And so basically they created a lawsuit based off of that. Now in mid-July, they're going to change everything and say that a buyer from now on has to pay for their agent's fee. And this is going to change nationwide. I'm excited about this change. I think it's going to be big, but at the same time, you'll still have the ability as a buyer to ask the seller to pay for it. So don't worry. If especially for my first time home buyers, if you're worried, hey, I'm just trying to save up for a down payment right now and I cannot make a buyer's agent's fee, then we'll ask the seller and get it that way.
Good to know. Oh, we're getting a lot of great questions in. Okay, so from Alex, let's see, this is for Ashley. Our FHA loan income limited like the USDA loan?
It is actually not. So FHA has no income requirement. Now, if you look at using a first-time homebuyers program, there can be an income limit on the first-time homebuyers program. However, on FHA, there is no income limit.
Okay. And then a follow-up question from Alex is the good faith deposit the same thing as earnest deposit? It can be between 1% to 3%. So is the specific amount told to us from the seller? Is it something we decide?
So it's 100% what you decide, and they are the same thing. Good faith deposit, earnest money deposit, they're the same thing. And you get to decide. The more of a deposit that you're willing to put down shows the seller that you're more serious with moving forward with the purchase.
Fantastic. Oh, here, another one is, what is the difference between a mortgage lender versus a mortgage broker?
Yeah, so there's a very big difference between the two. So there's actually 3 types of lenders. You're going to have your bank lender, your direct lender, and a mortgage broker. Now, at the bank lending, what's great about bank lending is if you like to have your payment with Wells Fargo, you can keep your payment with Wells Fargo as long as you're using the bank. The downside is they tend to be really restrictive on their underwriting and their turn time. So it's not uncommon to not close on time or have your offer not accepted because they're worried that that lender, specifically with the banks, won't close on time due to no loan officer education being required to work at a bank. Now, your next type of lender is a direct lender, and there is an education requirement for direct lenders. But with direct lenders, that's where you tend to see the highest interest rates. So with direct lenders, they have 5 layers of upper management who all collect a very hefty salary that gets hedged into your pricing. Now, with direct lenders, they can only offer you what they have, whereas a mortgage broker has a fiduciary responsibility to you as a buyer that no other lender has, because as a mortgage broker, we take one application and one credit pull. We don't ding your credit multiple times. And we can shop over 100 lenders on your behalf and make them compete for your business. Now, with that, we don't have 5 layers of upper management that gets hedged into your pricing, so your interest rate tends to be much lower in a broker environment than any of the others. But on top of it, and one of the most important pieces to that, is the fiduciary responsibility for us as a lender to do right by our clients.
That was really interesting. I didn't know about those 3 distinct ones. And then, oh, Taylor, you got a bunch of really great ones over here too. How about what's the red flags or common issues we should be aware of when touring properties?
Yeah, so when I tour properties with clients, I always tell them to look at the eaves or the fascia board around the home. I mean, that tells everything. If there's water damage, if the gutter's been leaking, you can probably tell that the seller hasn't been keeping up on the property like they should. But if they're very clean, if they're painted, especially newer paint, then chances are the seller's taking really good care of the property, and it's a good home, well taken care of.
How about what does an underwriter do besides background checks?
Yeah, so an underwriter is going to be looking heavily at your documentation. That's one of the largest things that they're doing, but they're also making sure that you're in a position to be able to pay the mortgage, because the last thing that we want to have happen is have somebody in a position where they are responsible for a large mortgage payment and are unable to make that mortgage payment, and the loan officer did not do their due diligence to protect their client. So that underwriter is not going to just protect the bank, but they're also going to protect the client to make sure that they're capable of sustaining their dream of purchasing this property.
That's good to know. Oh, here's a good one. So how do you handle negotiations between the buyer and the seller if there's a lot of back and forth between price?
Yeah, so that's a great question. It depends on if you're in a multiple offer situation. If that happens, there's things that you can do to make your offer stand out, such as the title and escrow fees. Depending on who pays those, it adds a little bit more cost, but it makes your offer look a ton better, and the seller's more likely to accept it.
Nice. And then let's see, going through, these are all great questions. Thank you so much. Keep them coming. Let's see. Oh, here's one we haven't talked about yet. What is a 2-1 buy down mortgage?
So a 2-1 buy down is where the seller can temporarily lower your mortgage payment. Now, with this, there's a little bit of a misconception because there's a fixed rate and there's an ARM, and an ARM is an interest rate that can change. And a 2-1 buy down is not something that's going to necessarily change on you. It's a 30-year fixed rate offer, but the seller can take a part of their proceeds and put that in your impound account where your taxes and your insurance comes out of. And then while they have that in your impound account for the first year, 2, or even up to 3 years, that amount that the seller has given you can be used to offset your monthly payment. Now, again, your interest rate is always the same, but we get to have this little piggy bank where the seller is essentially helping you make your payment for the first few years.
Oh, that's interesting. The, actually, another question I've been hearing about is, what is this? One-time California property tax?
Yeah, so that's that
That supplemental tax you mentioned?
Yeah, so that's that supplemental property tax bill. And for me, I'm hypersensitive about the supplemental property tax bill because when I was a first-time home buyer, nobody told me about it. And so I'm very passionate about making sure that my clients are educated on what might happen, not just during escrow, but after you close escrow. So as a first-time home buyer, I purchased a new built home, which means it was being taxed as land. Then when I purchased it, it was being taxed as a full-blown home. And my supplemental bill came 7 months after I purchased, which happened to be right around Christmas. And my supplemental bill was $7,000. Nobody had prepared me for that. So that one-time supplemental bill is something I'm very passionate in talking to my clients about to make sure that they're aware of what that's going to look like. Now, with that being said, most bills are not going to be $7,000. Your average is about $1,400 and it's split into 2 payments, but it's still important to know that your loan officer and your real estate agent is looking after you even after your escrow has closed and you're in your new home.
What a shocker. Especially during Christmas time. Yeah, but because of that, you are hyper vigilant about making sure that this is communicated so it doesn't happen to anyone else. From experience, that's interesting. So, oh, here's another great question that just came in. Can you talk about the California HAFA program?
Yeah, so the CalHAFA loan. So CalHAFA is a state-run first-time homebuyers program. Now with CalHAFA, there's 2 versions of CalHAFA. There's your traditional, and if you remember when we were going over the 4 different types of loans, and I was mentioning the minimum down payment requirement on each. So on FHA, it was 3.5%, and on conventional, it was 3%. Well, that down payment requirement's still going to be due, but CalHAFA is going to come in and cover that down payment on your behalf. So it's going to be a cake topper, not a whole separate program, where it's covering your minimum down payment for you. Now that down payment is going to be in the form of a second lien. So what that means is you have your first mortgage that you're making your monthly payment on, and then you have a very small second mortgage that's silently collecting interest on you at 1%. So it's not a very large amount. Now, on that second mortgage, you don't have to make any payments on it. But when you sell or refinance the property, you will have to pay that back so that they can lend it out to another family. Now, with that being said, there's an additional CalHAFA program that they came out with, and that's called the DREAM program. Now, the DREAM program is a program where the state of California will give you 20% of your purchase price that you can use for down payment and closing costs, which sounds great. But there's a few tricks with that. One is you have to be a first generational home buyer, which means that you cannot have owned a home in the last 7 years. And your parents can't currently own a home. And if your parents are no longer around, they cannot have owned a home at the time that they passed away. Now, they do say if you've spent any time in foster care, you will automatically qualify. And on a loan application, if you have 2 parties or a couple on it, only one person needs to qualify as a first generational home buyer. So that program is rolling out here in about a week or so. But when that program comes out, it's based off a lottery system. So there is a chance that you'll get chosen, and there's also a chance that you may not get chosen for that program. With that program, if you sell the property or you refinance more than one time, you have to pay back the 20% that they gave you, plus 20% of any equity that you had at the property at that time. Now, there's 2 ways to look at that. One is that it's cutting into your investment and you have to give California back 20% of any equity that you have. Or another way to look at it is that if you're not putting a down payment into the mix and having to pay your closing costs, when you sell or refinance the property and you pay that back, you actually made an 800% return on your investment because you get to keep 80% and you had no initial investment. So it can be looked as a positive, but it can also be looked at as a negative.
really like these interesting loan provisions. Here's another one, is that, can you go into more detail on the new home buyer program that's separate from the loan types you mentioned previously? Is it additional money or what?
Yeah, so those 4 loans that I mentioned, conventional is backed by Fannie and Freddie. And you won't hear about Fannie or Freddie a whole lot, except other than maybe a couple news articles, or I believe Toby Keith mentions Fannie Mae in one of his songs. But other than that, you won't hear about them too much. Now, the other 3 loans, your FHA, VA, and USDA, are all federally backed loans. So that goes into a separate pool, and that's referred to as Ginnie Mae. When we're looking at additional programs that are outside of Fannie, Freddie, or Ginnie, these are what's referred to as non-qualified mortgages. So you may hear of bank statement loans or hard money loans or 1-year tax return loans. So there's some different ways to qualify for a loan other than your traditional way of qualifying. Now, with those non-qualified mortgages is what they're referred to. Those are loans that should qualify, but because guidelines are so strict, they're unable to be sold in the normal pool of money to Fannie, Freddie, or Ginnie. So they have private investors who are investing their funds into offering you the money for this mortgage. So there does tend to be a higher down payment requirement. So on a bank statement loan, even if you're a first-time home buyer, it is 10% down instead of your normal 3% down. And the interest rate does tend to be a little bit higher. So instead of having a 6.875%, you might see an 8.5%. So it's important to know that there are options and other ways to qualify and get around mortgage insurance, but it's really going to come down to looking at what option is the most cost efficient to you.
That's so interesting, those little known loans. Taylor, I have another question that crosses my desk a lot, is the crystal ball question. So in Butte County, where do you think real estate prices are going within the next 6 months and 1 year?
Chico's such a unique place in that it's not the next biggest place is Redding and Sacramento. So this is kind of the biggest area around here. I think prices are just going to go up. And especially when interest rates go down, the feds have said this year that they were going to reduce the rates 3 or 4 times. They said that they were going to reduce them in January, and then it was moved to March, and then July. And I think what they're going to do is really start to do decreases in, somewhere around September. And when that happens, there's such a pent-up buyer demand right now, and so few homes on the market, that when interest rates do drop and it makes it more affordable for a buyer to purchase a home, that there's going to be multiple offers everywhere, and it's going to make those home prices go up in value and continue to go up.
Yeah, I personally feel like the real estate market in Chico is still very hot.
Yeah.
Let's see. And so, I'm glancing through the chat to make sure we cover everything. These are great questions, everyone. Thank you so much for bringing up these topics. If there's anything else that you've been dying to know, you have 2 incredible experts right here at your disposal. Please throw it in the chat.
There was one question that I saw from Alex. Are the 3 contingencies just for the good faith deposit or the final price negotiation? The 3 contingencies protect your initial deposit. So you put your deposit with the title company, and then your 3 contingencies make sure that if you back out, as long as you have one contingency in place, you get to retain that deposit. If you remove all of your contingencies and then back out of the purchase, then you will lose your deposit. But Ashley and I will make sure that everything is in place and that you are fully aware of that point when we get to that last contingency to be removed, so that if you happen to back out, that you'll lose your deposit. But again, we'll make sure that you're aware of it before it happens.
Okay. And then another question just popped up from Alex from in the beginning to end. Could you give a general timeline of buying a home?
Yeah, so right now we're doing a quick one. It's 21 days. A typical loan is 30 days. I've seen them get done faster, but it all depends on how quickly the buyer can get documents to the lender and how quickly, we can get inspections done. And it's a little bit more stressful. We can do it less than 21 days, but typical, is 30.
21 days would be fast.
It is, yeah.
3 weeks key in hand, that'd be pretty awesome.
Yeah.
Okay, wonderful. Let's see. Any other questions? These are great questions. Okay, and what I'd like to first, I just want to thank Ashley and Taylor so much for volunteering their time to share their expertise and experience with us. So what we're if you have any other questions that comes up as we wrap up, there is going to be a survey that will pop up when you leave the meeting. Please spend just a couple of minutes and respond to the questions, because we do take every single one of your responses to heart. We all three of us is very much into client education, and so we do a lot of different formats, from webinars to social media postings, to help our clients feel more empowered with information. So the more feedback that you give us as far as your overall thoughts about this presentation, this topic, our speakers, the PowerPoint, and any future topics that you would like to hear, the more we can give back to you with our brain and heart. And so with that, just one more check for any questions. Okay. If not, thank you everyone for joining us today. We really appreciate it. And again, our ask is if you just spend a few minutes to complete the survey so that we can serve you even better.
Thanks, Kim, and thanks everyone for coming.
Yeah, Kim, thank you so much for giving us a platform to do this education piece. And thank you guys so much for coming and hearing a little bit about what we're doing. And if you have any questions at all, you can reach out anytime. And thank you all again for your participation today.
And again, the replay will be sent to everyone that registered as well. That'll come out in a couple of days. Good night, everyone.